So I'd like to say thank you for everybody for coming. We've got Craig and Richard from Axia speaking today. I'm going to let them introduce themselves, so this won't be a big introduction. But before we start, we'll just go over how we're going to deal with questions for the event. What we're going to do is Richard's going to answer questions at the end. So if you can, please put your questions in the Q&A feature in Zoom, not the chat. You're welcome to use a chat throughout the event, but we're not going to pick up questions from there. Or rather, I won't, not we. So it's my job to give the questions to Richard at the end of the session. So I'll be looking at the questions as we go through and making note of them. So we're not going to answer any questions during the end. Doesn't mean your question won't be answered. And with that, I'll hand it over to Craig and Richard. Hi, guys.
Cool. Thank you, Peter. Awesome stuff. So I'm just going to do a very quick intro about Axia Futures, and then I'm going to hand it over to Richard. So my name's Craig, as Peter said. We're coming live from the Axia trading floor here in London. If you're new to Axia Futures, we basically house a lot of some of the biggest traders in Europe here in our offices in London. We've got presence in Poland and Cyprus, and we aim to produce high quality training that's based on what professional traders on our floors actually implement in today's markets. So I'm excited to be presenting this workshop with Richard, who I'll hand it over to in just a moment. Just take a moment to read this disclaimer. Everything that we cover today, it's not financial advice. It's just a standard little disclaimer that we like to show here. So now that that's out of the way, in today's workshop, you're going to learn from Richard about how to trade market moves with the volatility scalping technique. But before we go any further into that, if you've joined one of our workshops before, then you may already be familiar with, the Axia story and how we got started. But for those who are meeting us for the first time, I'd like to introduce ourselves and tell you a quick backstory about how today came to be. So what I'm going to actually do before I go any further is turn off my video so I don't get distracted by my own face. But just to give you some background, a lot of the founding traders at Axia, our senior and lead traders, they started their careers in the 2000s and 2010s on a London trading floor with loads of traders all trying to make it in this game. And this is where they came into contact with our co-founder, Alex Haywood, who's this guy on the right here. And on that trading floor, he coached and observed many of the top traders on the floor and developed a training system that modeled behaviors and best practice from the best performers. And the approach became effective of modeling the best practices, and it inspired other senior traders who enjoyed helping develop traders on the floor. And fast forward today, many of these traders now make up our team of multiple 7- and 8-figure traders on our floors in London, Poland, and Cyprus. And since starting Axia Futures in 2016, there's a stream of young mentees on their tracks, traders who've learned how to build professional trading careers based on what's been put into practice by a proven team of top performers. And many who train or trade with us remotely and report that it's the type of training and support they don't find in too many other places. Now, since then, Alex and some of the other Axia traders have made appearances in places like Bloomberg, the Chat with Traders podcast, Real Vision Finance. And all of this is to show you the impact that Axia as a community has had on the lives of their careers. So there's a part 2 to the story. And back in 2016, it was a few months before Brexit. And while many of the founding traders were still relatively young growth, high growth traders at the trading floor I told you about earlier, something unexpected happened. And that's essentially that they were forced to restart from scratch. So the company handling trader capital mismanaged the funds, and many traders woke up one morning to find that their accounts had just disappeared overnight. And unwilling to give up, a group of them pulled together and sourced financing from friends, family, and contacts who believed in them, and they set up in a small London office and came together to trade the Brexit referendum results, which you may recall that created significant market volatility and major overnight moves. Some traders even slept next to their desks that night to avoid missing the open. And basically what happened was they traded well and bounced back, well enough to secure their own office, and thereby launched Axia Futures. And since then, many have gone on to achieve 7 and even 8 figures in just over 3 years. You can watch multiple examples of their live trading on our YouTube channel. These are all on live trading accounts. You can definitely check it out if you haven't already. But these are real traders with real capital and risk, with real profit and loss, all transparently available on YouTube. And in today's workshop, Richard's going to be shedding a bit of light on how they're able to achieve these kinds of results and get basically what our traders demonstrate on a regular basis. So in today's workshop, just to give you a quick overview, what you're going to learn is how to trade the news without having a news terminal or needing to interpret data. So then we've got the volatility scalping technique used by traders at our floor. We've got recent performance stats of traders at Axia. a recent real-world example of a trade executed in the yen futures markets, broken down step by step. And then you'll learn how to recognize order flow that suggests large moves maybe on the cards, and a whole lot more. So I'm going to hand it over to Richard. Maybe if you're familiar with Richard, you kind of know his story, but I'll just give a very brief intro of who he is. So Richard is the head of training at Axia Futures, and he's responsible for developing all the strategies that are used by our traders. He started trading in 2008 and has since then helped further develop the Axia training method, which is taught to all the traders on our desks. And he's mentored many from junior to elite, so he really knows what it takes to build a successful career from scratch. So without further ado, I'm going to hand it over to Richard. Richard, over to you.
Richard, you're still muted.
I've just realized that as I started talking, I realized that. So there you go. You heard nothing. You saw some miming. But no, great to be here. Thanks for the intro. Yeah, I was unfortunately one of those traders at the previous trading firm, which I'm sure some of you know what firm that was and what happened. We don't need to go into reliving that sad event. But today's not about that. Today is about, well, how to understand order flow and how to use volatility created by news or not to give yourself an opportunity, and also how to just recognize small subtleties that tell you this is a move that's about to start, small subtleties that tell you this is a move that's got a continuation versus one that's going to reverse. So I'm going to show you two examples today, and also an understanding of, well, what changes as a news story or as a pattern of significant volatility unfolds, and how this changes and how you need to react to that to deal with the future examples of it, because anything that once it's seen once is not traded the same the next time. People are never going to be able to do the same thing and repeat at another time. So let's go and have a little look. I'll explain the first trade and then we'll walk through the sequence of trades. If anyone's been watching the yen recently, there's been a lot going on. So today I will share my screen. There we go. It's all about volatility scalping. What do you do on a fast move? What do you do when a fast move has already started? And how do you get into that move after the move has actually started? And how can you also just scalp around the volatility? Some of our best traders, we got a lot of videos on YouTube of people, and one of the top people who's generally seen as very macro orientated, deep down, he is essentially a scalper. If you watch a lot of his videos, it's predominantly about constant trading through the volatility. And it's the volatility brought by news, which is what he trades. It's not necessarily he's always trading the news. Of course, having an understanding of news helps, but it's about understanding volatility and how to trade around that. We're going to cover a bit of volatility today. What we're also going to be doing in a few weeks' time, if you want to sign up, click on the link there, elitetraderworkshop.com/scalping. I'll be showing you 3 more scalping strategies, looking at reversal strategies, stops plays and how to not get caught on them, and also how to not get caught by people manipulating markets. So get onto that link and you can come and join that workshop, which will be coming up in a few weeks' time towards the end of November. Right then, let's get on with it. How do you trade news without there being news, or without you knowing what the news is? That's the thing that we're interested in. You don't have to be a news trader. You don't have to understand all of this in order to be able to trade that volatility. So the story is, and what happened was, on the 3rd of October, we had this one gigantic move in the yen. And I'm sure many people perhaps saw this, perhaps wondered what it was all about. The initial assumption is this is some kind of intervention by the Bank of Japan. That's what you assume has gone on. But as it turns out, there was no intervention by the Bank of Japan, or at least there was no confirmation that there was. Bank of Japan said, no, nothing to do with us. But by recognizing the order flow that looked similar to this type of action, people did extremely well out of it. This on the left is performance by traders. So obviously I've blanked their names out, but what you can see there is the vast majority of traders. Only 4 traders were down out of the group in London. 4 down, and huge upside for the ones that are up here. It's nearly 10x on the upside for some of the biggest winners compared to the biggest losers. And it's all in the yen. Yes, there's a little bit of performance in S&P, but it's all in the yen. Now, if we go and look at a few traders of that group, some trade lots of markets, some trade very few. But what you can see here is a very distinct performance by hour, a very distinct performance by market, being the yen. And look at the amount of trade. Yeah, it's 9% of this trader's performance on the day. Pretty minimal. It is, again, another 9% of this trader's performance. And yes, this trader's taken on a few different markets. They've taken on a little bit more in the S&P and the NASDAQ. But again, you see that huge jump in performance that comes at 3 o'clock. This one up into the 70,000+ just in the yen. Previously, 45,000+ just in the yen. And then also another 22 in the yen, which again accounts for roughly sort of 10% of their trades. But it's about recognizing what was going on and that sudden change. And this is ultimately what trading's about. It's about recognizing that there's something different here. There's something big and you need to be part of it. You've got to get onto that trade and you've got to size up on it. And if you can recognize what that flow looks like, that's how you can take this trade on. Yeah, the traders that did very well here, and this is not just all of the senior macro traders. I've actually not shown you some of the best performances here. But some of our newest grads did really well. You know, one of the guys who's currently on the funding trial made about $4,000 on this with very, very minimal size because he recognized the type of movement that was coming through. And this was the 3rd of October. So this was the big one. We got some big across the board performance. This is why 140 ticks in 2 minutes. Now, everyone looks at the spike. That's the big exciting bit of this, right? But that's not where you make your money. Where you make your money on a trade like this is being able to spot something changing down here. In these few candles down here and moving into this first bigger candle. As this starts to happen, it's what happens there that makes you your money. Chasing the market up here is dangerous. This is where you get yourself into trouble. And we'll be talking about that in a moment and what then happens after these types of events. But this one's huge, 140 ticks in about 2 minutes. But note how far back this comes back, but still holds up. Just to give you a little bit of scale, this is what it looks like on an hourly. And we're going to get on to having a look at these in just a moment. So bear with me. We're going to get there because what's important to understand when you're trading the subsequent ones is what's happened before. So scale of this is enormous. It takes out the previous 7 days worth of range in 1 minute. So what does all of this mean? This is crucial to what you do next. What we know is there's no news. So there's no news going on. We have a suspicion as to what it might be. As with almost all news stories or all big changing events, the first one is the big one. That's the huge move. It's the first action. And so as it starts to move, everybody jumps onto it. Everybody chases and the market then rushes higher. It's a race to capitalize. People are not straight to the party on this because people weren't expecting this. On the 17th, you get a repeat move. And crucially, and this is where the junior trader that I talked about did so well, he recognized the level that this started from. And essentially, he watched the market as it got there and thought, you know what, if this starts to tick up from here, I'm buying this. And he did exceptionally well in doing that. But he's noticed that. And this is what I mean by awareness. He's noticed that. He's not going to be the only person in the world who's noticed that. And so therefore, there's going to be a lot of other people doing that same thing. As a result, the market doesn't move as far because when everyone buys early on, expecting this big move, as soon as the market starts to move, they then start to take their profit, which prevents the continuation. So you get a more limited move the second time. And again, no news story behind this once more. But the people who recognized the pattern were the people that did well, the pattern of the level. Next up, and this is one we're going to go and have a look at in just a moment, is the one where the expectations are high. People have seen this happen twice. So people are very, very ready. If the yen starts to tick up, they're going to jump onto this. So this is what I mean by being able to adapt and being able to recognize the sequence. This is not about the news anymore. And once again, there was no news. But what it's about is understanding who you're up against. Understand your opponents. Obviously, there's 500 plus people joining us today. All of these people are your opponent. And so what you've got to think about is they're all going to be ready for this. Your goal now is to beat these people in and to beat these people out. Because if you don't do that, either you're going to be late buying or you're going to be late exiting. If you're late on either of those, you give yourself a very, very small amount of profit that's potential in the middle. And then what we're going to go and have a look at is the actual news. And there's a distinct similarity in the way this starts and a very distinct difference in the way it continues. One, it's actual news, but you don't need to know the news. So many of our traders that are seen as, macro traders often are actually getting onto news stories by seeing the flow coming in before. They're recognizing that little bit of volatility, which may be a scalp when you first get in. But if news hits, then you can carry that position forward and you can hold on to the position as well. So we're going to go and have a look at the second two. Understanding the sequence is key to being able to recognize how to deal with these two. So let's go and have a little look at what happens on the 17th. Repeat, same level, same move. But this one, much, much quicker. You don't get, as we saw before, too much of this steady movement higher and then an explosion. This time, it's just tick and then it explodes. And you see the depth of the pullback. On the one previously, we pulled back to around midway and traded there. But on this one, we pull all the way back. And so if you're late buying it here and you're slow getting out, you're probably taking a loss on this trade. Whereas with the first one, you could be a little bit later because not everybody was in the game straight away. In terms of scope of movement, again, this one slightly smaller, takes out the previous couple of days' ranges. So let's get on to the 26th then. This is the one we're going to go and look at. How do you actually trade this? And what you'll actually see is somebody who's a little bit slow in getting out because they've kind of waited to see if there's any more in this. And you've got to look at these types of things and accept that you're not always going to get the biggest move. And part of the game and part of being able to scalp effectively is to be able to recognize that, well, I've got to give this a chance to keep going. And if it doesn't, then I'm going to have to give up on the trade. So let's go and have a little look at this. This is the one on the 26th. I'll ping this up onto the screen for you. So what we've got is also a footprint next to you, because one of the key things that you want to recognize in this is the way the market starts to move on this one. So let me get this going for you. Right. What I'm looking for here is I'm watching the last traded quantity and I'm watching the way that this trades higher. I'm watching the way it trades into these offers. It trades up, see 58 trades, and that offer disappears. Now, at this point, I'm not thinking, oh, there's a news story coming on. But you're going to be starting to think, oh, look, another 80 lots traded and it took the offer straight out. You see that down here on the footprint, another 170, another 100. The buying's becoming more persistent. It may not be fast here, but you're seeing that subtle change. And it's just these little changes that's enough. Now, obviously, the market's not yet got quite volatile. So if you're looking at this, you're thinking at the moment, this is a potential little order flow scalp. I'd be playing it long from here and looking somewhere up here where you've got this little bulge of volume. And that would be around about it on this trade at this point in time. But what I'm consistently watching is this last traded quantity. And I'm consistently watching as it starts to tick up, whether the bids follow it. And they do. You see 90s, 70s, 50s, 30s. The bids are moving higher and we keep on buying and buying and buying into the offer. This is where you can add on. Remember, I said at the beginning, the key to any of these trades is the ability to recognize the starting of the move. And that was the bit. The way that started, and it's just steady, tick, 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 but it's all buying. The way that happens says to you, yes, you need to buy, but you can buy more down here. This is not about just get in and sit there. Get in more, because that change in the way the flow is coming says to you something's going on here. Somebody really wants to buy this. Now, at worst, this rolls back to where you started. People stop buying, and that's it. At best, this turns into a much bigger move. But at the moment, I'd be looking at this thinking, okay, as long as somebody keeps buying, I'm going to be quite happy to hold on to this And then if we start to see more two-directional trade, there's your order flow scalp. I'm out of this. But instead, what we get is a market that starts to tick higher. And now it starts to accelerate. And you see this is quite quick. This is where you start thinking, this is like what happened before. It's going to get faster and faster. So whatever you've got on by now, you're thinking, right, I need to hold on to this. And my first thought in a situation like this is always, I'm looking at the high. I'm looking at the high and thinking, get there, I can cover something, and then we're going to see what happens next. Market jumps over the high. And this is the point where being aware of your opponents matters. So I've just paused it there, because what we've done is we've traded up over the high, which was at 18. We've jumped, 67.18. So we jumped over the high. We traded up to 29. So we traded 10 big ticks through the high in the yen. And then we've come straight the way back. Now, as a scalp, what you've got to think about, and as somebody who's trading that sort of build up in pace in the market, this is essentially an exhaustion move. So the market has now jumped. You're aware of what the previous high was. That previous high was 18. Now, you've got to give it a little chance to see if it will bounce there. But when it doesn't and it goes straight the way through, this is now where you have to be aware of what's happened previously and what other people are going to know. Other people are going to be watching this as well as you at the beginning of this move and thinking, I need to get onto this. So now there's lots of people long like you. Everybody's looking for an exit. And this is a potential for a reversal trade. In fact, it's not what we're going to cover today. We'll cover that in the workshop at the end of June, the day before Thanksgiving, on the Wednesday, for those of you in America. So when it comes back to 18, this is where you have to recognize that you're now in a scramble to get out. Get yourself out of this as fast as you can, because as you see, if you chase it down, you're getting left on the offer. You're getting left there. You're not getting your fills, and you're going to be getting filled far, far lower. Not what you want, but this is what you have to kind of accept with these types of moves. You get in quick. The key is the money is made on this by recognizing the flow at the beginning. That's where you make your money, because this has given you an excellent entry point, meaning that you can get out of this with a degree of reasonable profit. But as soon as it starts to drop through, you see where it's found that support at 08 and it's stalling. Once it drops through there, you've got to get out of this. And if you don't get out, the market then rolls all the way back. And that's where you end up in trouble on this trade. So the key bit is, yes, give it the chance. But as soon as it starts to roll back and finds a bit of support, then it rolls through, the move is over. That's what you've got to look at and think, okay, I need to be out of this. And the key bit there on that rollback, and this is important for the next one. Think about it, that you're always learning what's happened here and how is this going to help me next time. When we rolled back, we stalled at 08. So it sits there at 08, 09. What you've got to be thinking at that moment is, if this drops through, this is over. I need to be out of this. If, however, it holds here, then you have the opportunity to play another scalp move up. You can buy more and play this back up the range, but only if it holds, if it shows that buyers support this move. And the reason they don't is because, once again, we've got a quick move. There's no news to support this. So there's no reason for anybody to stay in this trade. So if there's no reason to stay in the trade, everybody's now going to rush to exit and you get this scramble down. Be aware of that, because this is also a short opportunity, which is something that we'll talk about in the future. Right. Let us move on, and we'll go and have a look at that next one. So that is what I would call a smash and grab trade. That's what S&G means on the 26th of October. It's a smash and grab trade. You know the risk that is apparent for you. You need to get into that trade and get out of that trade very, very quick. Right. Let's move on. And you see, it's a much smaller move as well. It's quite muted. It's sort of a quick jump up, back down, and that's it. And that is because everyone's trying to snatch their profit on this. That's part of understanding that volatility. Right. So what we've seen then And what we're trying to do is distinguish the type of action that you see. What we got on the first move was, or on this most recent move, the first part of it was this steady buying. So you got those large clips. This is a clue. This is something you should always be watching for. Steady, larger size clips going through very often means that somebody's got some kind of information and they're trying to get their business done quick. There's the first bit of clue. That's what you need to spot to be able to get into these types of moves. Then you get the change. I'm always looking for change. I was on the career course this morning, this morning, earlier on this afternoon. I was saying to the guys, one of the most important things about order flow is just change. And what I mean by change is you've seen what it's doing, and then it starts to do something slightly different. It might be a little bit quicker. It might be a little bit slower. It might be larger orders. It doesn't matter what it is, but change should focus you. Change makes you think, right, something's going on now. I need to be part of this. And as you got that much quicker flurry of buying, this is your chance. If you're not going to jump in here, this is where you start to miss out on the move, because now everybody's aware. Some people would have seen that first start. Some people then see that little change. And then after that, the market accelerates. Once the acceleration comes, you've missed it. And if you're waiting until then, you run the risk of buying highs. And if you buy highs on a highly volatile move, the market rips back on you. And before you know it, you're a long, long way offside and you're now starting to panic. So it's not about just seeing the volatility and trading that. It's about watching the preamble to it. And it's that preamble that lets you understand how to scalp the volatility when it appears. Right. And then finally, the end of that comes where you get no support. So what ends up happening is you drop back, no support at 08. And as soon as it drops back through there, then you get the reversal. This came after that exhaustion through the high. So when you've seen that exhaustion through the high, drops back, no support, game over. You need to be out of this trade. Now, this is different when you actually have some news. So when you actually get some news, you get a different type of movement. Look at the last ones we talked about. On a 1 minute chart, they were pretty much one big candle, huge wick and back. This one with news, you get what I call a smoking chimney move. Jump, pullback, continuation. And what's key about this trade is what happens in the middle of this move. What happens down here? This is that pullback, but this time it holds. And this is the area that you can scalp. It spends 3 minutes trading up and down in this area. And if you can recognize that support and it hold on the way back, you can actually play this move multiple times. This is where, if you see that market, the market holding in that way, you're able to then actually miss this bit. If you miss that and you see the market holding into this range, you can actually play up and down the range. You've got maybe 10, 15 ticks to be playing in here. You can play up this range. I would generally play it one directionally. That's one of the key bits to volatility scalping. Play it one directionally. This is clearly a market on the way up. Play it to the upside. The last thing you want to be doing is trying to go against a market that potentially has got some news in it. Whether you know the news or not, it's potentially got news and a reason to be surging higher. So if that's happening, play in that direction. If it keeps going, wonderful, you're in for the bigger move. If it doesn't, well, at least you're not going to get caught out too much because you're buying the bottom of the range playing up. If it starts to roll through, you're out, just like you saw on the 26th. So let's go and have a little look at this one. It's a slightly longer one, and we're going to look at a few different elements in this trade. So how do you get into it, and then the scalping the volatility within that so that it covers, well, different people's speed. You know, if you're really quick to recognize the pattern, great, you're in from the start. If you're not so quick though, there's still plenty of opportunity in this. So let's go and get this one going. And I will show you what I'm talking about. Right, so here we go. This is the next one of the sequence. I'm just going to get that so we can see it there. So, right, let me just give you a little bit of scope as to where exactly this market moves from. So we're starting off down here. Whoops. We're starting off down here at around about 67.28. in the yen. And we move up in that first move to around about 67.50. So just so you've got a bit of context as to how far this is moving. So it's around about sort of, 25 big ticks. So it's a smaller move, but it's a more persistent move. And this offers more opportunity. It's not always about the size of move. It's about the persistence of move, because that gives multiple chances to trade, multiple opportunities to get into this move and continue to make money scalping within the movement. So let's get back to what exactly happens. Right then. Again, there's not a great deal going on at the start of this. And this is where, again, you're watching the market, you're seeing if there's anything different going on. Now, the market's just ticked up briefly there. Not a great deal of reason to want to be in this, but it's had a little brief tick up, which might give you a little clue. Maybe you want to be trying to buy just because we ticked out of the range. So it's been trading down in this little range down here. We've seen from a footprint a lot of support. Now you get that 150 buys. When you get that, that's where you're thinking, oh, this could be the same as last time. So what I'm then focused on is, do we see the bids moving up? Do the bids remain strong? There we go. We start to see that skip. That little flurry of action says to you, yes, something's going on. And this is where, again, you want to make sure you can get in as quick as you can. I'd have eyes on 32. Very little volume traded at 32. So that's going to be the first area that I've got eyes on. So we create a little list of levels. Eyes on 32. That's going to be my first area of support. If I can buy there, wonderful. Very, very happy to be able to buy there. But you see, it's still quite steady in this move up. But as it moves, it's still constantly chasing with those bids. So the market's now chasing up. As it's doing so, you can continue to add bid orders, because this, again, has been a lot steadier. It still doesn't feel like it's absolutely rushing. Now that it really starts to sort of pick up the pace, you might be a little bit more wary of this. But even then, it sort of pushes up, it rotates back. It pushes up, it rotates back. Exhaustion moves like that, always worth taking something out of. That's one of the key bits of volatility scalping. When you get a jump, take some profit out of it. And what you're now starting to get is the market whipping back. This is where people panic typically, because they've just seen the market jump up. And particularly if you're someone who's chased it, and this is where you never want to run and buy when a market jumps like that. If you chase it on that move and you buy it up here at 50, you're now panicking and you're thinking, I don't know how badly this could go wrong. This could go through the floor. And you start thinking, you start really worrying about how badly wrong this could go. This is not where you want to panic. And I understand why you would if you've gone and bought at the high. So it's crucial to understand where you need to be executing in these situations. The market's now just dropped back. Just like the previous one, you want to be watching here. Where does it find support? Where does it start to stall? Now, if you remember, I talked about 32. It then also held at 38 as the market started to move higher on the first initial move up. So that was just after this little jump. Whenever you get these sort of accelerations, which is what you call an imbalance when you're looking at footprint terminology, where you just get buying strength or selling strength, I'm always looking just above that as an area. So that's going to be my area that I'm interested in. So if you can get there, wonderful. I don't really want to see it down at 32 anymore. So I'm watching now at around about 38. What is going on? So we come back down, trade 37, trade 38. Now look, difference. 200 lot jumps onto the bid there. 500 lot jumps onto the bid. This is different. This now on the pullback is not holding back. And so you've got this rush up. Now you notice no profit's been taken immediately. But what you've got to be looking at, because it first thought is this is going to go back through the high. But what you want to be looking at is where does it stall on the way up? It keeps stalling at 46. So this becomes your reference point now. So I'm watching 38 and I'm watching 46. I'm trying to sort of find my range. Find where does the market stick on the way up? Where does the market stick on the way down? So that you've got that in hand and you go, right, gets back to 38, I'm happy to buy. Gets up to 47, I'm happy to sell. I'll just get the market to rotate between those areas. So Then what you can do is you've got yourself a reference to take your profit. This is what we mean about volatility scalping technique. Soon as the market moves, you've now got this pace in the market. You know people are willing to continue to buy. You, by this point, may well know what the news is as well. So now you're looking at it from the perspective of hold some of your core position, and then you can sell around 45, 46 and buy back around 38. So you keep on looking to try and build your position back up down here with the view to try and hold this for a move through the highs and that exhaustion move through the high. You see how this is different already. It's still volatile, but it's slowed down. It's calmed itself down. And this is because there is reason to stay up. Unlike before, where there was no reason to stay up, you never got any confirmation of news, never got a reason to believe that, yes, the market should be staying up. This one's different. And so now what you're looking for is you're looking for this patient build as we move to the next phase. But you can see how we've managed to take so many more trades here. Traders managed to buy down here on the initial moves and sort of always view this as your core position, the bits that you bought down here. But on the back of that, then managed to buy multiple times on the way up. Yes, we got a couple of decent exits on that first spike, but now if you look at all of these buys, we're getting these out up and around the top of this range. This is where the market keeps on sticking. And I said, one of the key bits when you're volatility scalping is always to go with the move. Stick with the move, because if you're buying down at 38 and we roll through 38, you can give this up. You can give it up quite quick, because if we can't hold support on the back of this clear move to start with, this move's over. Whereas if you're trying to guess the short, it's very dangerous, because you could get stuck on this one where we actually now start to break above 46 and we start making our way towards the new highs. This is now an opportunity to have a go at potentially buying some more. You can buy above that 200, but now you should be in a position where you're thinking, yes, we're looking good now. We're looking good for a continuation. I can hold on to this. We can keep this move going. You know also where the previous highs were. You've got this 100 lot that's helping you out as well. That effectively is your stop now. Because you've moved out of that range, you've effectively now got a stop that is moving for you. So I'm always looking at, well, what's going on right now in the order flow? You can't predict who's going to turn up. You can't predict how the market's going to move. So what you want to be looking at is, well, what references have I previously got? And what have I got to help me out? That 200 was everything that you wanted. You saw it comes along. That's where you think, yes, the market's going to go now. And when it gets filled, this is the bit that says to you, right, in the short term, this move could be over. So it's always about constantly updating yourself. Updating, right, where's the range establishing? 38 to 46. Okay, so you can keep buying 38, you can get out at 46. Buy 38, get out at 46. When it goes through 46, you can buy more. Don't be afraid to add on. You know, you could add on here, as you see. Okay, adds on, gets to the high, you can cover up here, gets through the high, and fails to keep on going, fills that 200, you can cover again. Now you're thinking to yourself, right, I want this to keep going. If this doesn't keep going, I'm giving this one up. And so as the market then starts to stick around 50, you've got one last chance. Either you give it up here, where you break back through the previous high that was 52, or you get out below 46. You would expect 46 to offer support here, because that was the top of that previous range. You'd expect that to now offer support. If it doesn't, you've got to give this one up. So you eyes on 46, eyes on 52. But because you've been able to sort of work this position, now you have the ability, the banked profit, the understanding of the way the market's moved, to be able to now let this go and see what more you can get out of it. You may not get anything more, but this could well turn into that continuation move. If it does, you're very, very well placed to be in this. Not only have you got an average price much lower, you've also banked so much profit from all of those scalps along the way. So what we call bankrolling a trade. You're able to hold on to this now because of the number of times that you've taken 38 to 46, 38 to 46, and all of that money stacking up covers you. That means you can now sit through this. If this rolls back, you're fine. You're not in any trouble. And you can hold on to it. When you get that exhaustion move there that you're starting to see now, this is where, again, you go back to what we've seen previously. The exhaustion is the bit that says to you, you should get out of this. Bank your profits if we start to roll back through here. So you see this trader's still holding on, still looking for more, because again, they've been able to sort of bank something. But once you then start to fall through areas of support, then you see that scramble back down. This is where you start to say, yeah, I need to get out of this one. It's changed. And again, I talk about change so often. That sudden change is that bit that says to you, yeah, this could be over now. And remember, as a scalper, your job is to react to the most recent bits of information. As a scalper, you're now looking at this thinking, something's changed here. I probably don't want to be in this one anymore. Now I can start to get out of this trade. This doesn't go back up, particularly if it doesn't get back up through 55, which is where we just surge down through. This move's probably done. So you're looking at this thinking, yeah, 55, so I can get that. I'm very, very happy with it. Scalping is all about recognizing what's happening immediately right now and constantly updating what is realistic. Yeah, as we went through the highs, you're thinking, yeah, this could go and go and go. But when it rips back through 55, that now becomes your best case scenario. If you can get 55, great. If you can't, you're looking at 52 now, which was the previous high. It's always about constantly updating. But if this had kept going, then you would have had the opportunity to potentially scalp another range. So it's always looking and constantly updating yourself. It's a very dynamic way of trading, and you adapt to the volatility as it comes along. But that's the key to volatility scalping. That's what it's all about. So hopefully you guys have picked up quite a bit from this. Hopefully we've seen multiple different variations of ways to trade on these types of events. Key thing, recognize change. Recognize sudden pick up in speed, a sudden increase in the number of orders going through, size of the numbers of orders going through. When you've got that, you're in a great position where you go, yes, this is something that I want to be on. And because you're constantly and dynamically updating where you are, what's happening along the way, you give yourself the ability to adapt your targets, to adapt your potential increase on the trade, to accept that this move is over. You're much more adaptable. And by taking on multiple trades, what you're also doing is bankrolling the ability to stay in a trade for far, far longer. That's the key to volatility scalping. Right. On that, from my side, hopefully that's given you a huge amount to go on. We will be covering more of this in the near future as well. As I say, Wednesday before Thanksgiving, we will be doing a workshop. Then get onto that link. I'm sure we'll be able to pop that into the chat for you. So it's elitetraderworkshop.com/scalping. Get onto the link and we'll be showing you reversal techniques, stop techniques, and also how to recognize manipulation, how to recognize people trying to cheat you, and how to recognize how to make something out of that without doing anything illegal. Right. I think we're probably out for some questions.
Okay, let me just go through. Right, one of the guys asking, how do you learn to interpret the time and sell so quickly?
How do you learn to interpret it so quickly? The easy answer is experience. Obviously, I've been in the business since 2007, but that's not the answer that anybody's looking for. And yes, I can say experience, but what it's about is, and I was talking to some of the guys on the career course today, because that's what we've been doing in this whole of the last week. What it's about is being able to say to yourself, right, and the best way that I go about learning this, look for a level, ask yourself before you get there, what do you think is going to happen? And what would you like to see? So that this way you can now look and go, okay, I think the market's going to bounce off this level. So what do you want to see? You want to see buyers continuing to place their bids. You want to see buyers actually hitting into sellers. And so now you can go, okay, that looks something like what I want to see. And that way you start to interpret it faster and faster. Give yourself reference points, reasons to look, and also at least a rough gauge of what you're looking for or expect to see. Now, if you don't get what you expect to see and the move still works, well, now you've just been informed that this is a new thing that you could look out for. If you don't get what you expect to see and the market falls through the level, let's say, well, now you can say, well, that's what I don't want to see. So if I see that in future, I don't want to be part of that. So that's how I always start from a reference point. Always start from being able to go, right, what do I want to see here? What do I want to see here? And that way you get to interpret much quicker. You're on a volatility one like that. As I said, what I'm looking for is as the market washes back, I'm looking for it to find some support. I'm looking for it to wash back and it stick. And so it starts to bounce off a level. I'm not looking for, perfect to the tick. I'm sort of like, right, I said 38. Sometimes it traded to 37, sometimes 39, sometimes 38. But I'm looking for where does it seem to stick? So I'm looking almost in ranges rather than in specific prices. And that's how I sort of learned to interpret things. So there's not a sort of clear cut, this is how to do it as such, but give yourself points of reference. That would be my biggest piece of advice.
Yeah, that's a great answer. Former career program student asking a question. What type of trader would you expect to be tracking the yen in the moments leading up to the move? Did the trader deem the yen a market in play, and that's why they were watching it with that level of granularity? Or was there a higher time frame strategy he was tracking?
On the junior trader who took the second one particularly well, this was a case of, and it does require an element of understanding of what's going on with the Bank of Japan. Now, the yen has been weakening massively recently, and the Bank of Japan doesn't want to see this continual weakening of the yen. It's not good for their economy. It effectively creates inflation, but not the inflation that they want. This is what you called imported inflation. We're not going to get into a macro workshop today, though. So that's not what they want. So they now want to try and give the yen some strength. And they've done this a couple of times by saying, we will intervene at this level, or we will do this. So when you start to see that type of movement, you think, oh, maybe it is the Bank of Japan. And so you're looking at the technical level and go, right, this is the level. If we go back there, I can expect to see something. I need to be looking at this. I'd always do this day on day. If I see a market react at a specific point, whether there's any news, I'm going to be thinking, right, it reacted from there yesterday. It did something that's not typical from there. I'm watching that level the next day. And so that's sort of part of the in play, just from a technical perspective. The macro knowledge of, right, what's going on with the Bank of Japan at the moment, the fact that, often you get this type of thing, post Bank of Japan decisions or before future decisions. That's where you bring in a little bit of macro understanding. So there is a macro element, but crucially from a technical, it's a case of this level created big reaction. Let's see what happens next time. So that's essentially how it became an in-play type trade.
Right, there's a couple of people asked it. I think you might have said skip Pierce up, and then people were just asking what that meant.
Was this a typo? I don't know if anyone can see my screen.
You can still see your screen now.
Yeah, I'm just having a quick look. Yes. Skipping Pierce up. That, my friends, is a typo. So I do apologize for that. I may be good at recognizing order flow. I'm not particularly good at typing. So what's gone on there is essentially, that flurry of buying, the price skips. So it doesn't go miles, but when you see a market that very quickly takes out prices, and you'll see it on, say, a footprint, but you see it on the price ladder as this kind of skip. And what's happening there is buyers are just taking away all of the offers, say 3 or 4 offers in one. So you go bang, bang, bang. As that happens, this means something. If you're in range as well, and this is crucially different to a stop, if you're in the middle of a range and it does that, that's what says to you, yes, the buying's really on. People are willing to take out multiple prices in a range. This tells you need to get onto this move. And so that's your last chance. And that's that little change. So I do apologize. It's not Pierce, it is price. So buying skips price up, bang, bang, bang. That's where you go, right, this is the change I'm after. Get more in. This is your last chance. Otherwise, the price stops skipping up and starts to surge higher. That's where you're really missing out because it's flying away from you and it's too fast at that point.
Okay,
so hopefully we don't get any more typos in future.
No problem. So how do you decide what size stop to use in these types of trades, as presumably they're more based on intuition rather than pre-planning? So how do you game plan the amount of risk you give each attempt?
Okay. Right. If I take you back to, let's go back to this one down
Hey,
here.
hey, Richard, I'm sharing the slide where it's just got the link for the scalping strategies.
Aha.
So
Right.
if you do want to share, then just hit the button to share and you can take over.
Perfect. Right. Here we go then. Right. So you can see this one there. Right. So what we looked at here on this one, I'll try and draw this one out. When you first enter the trade, right, we saw that first little bit of buying coming in down here. Steady, persistent. For a stop on that, I'm looking quite technical there. I'm looking at, right, well, we were in a small range. I'm thinking to myself, right, well, if I bought at 30, the bottom of this range is about 27. Remember, this is a scalp type trade. I'm reacting to what's just happening. So if this stops happening, I don't want to be in this anymore. So there's two parts to it. One is technically, I want my stop below the bottom of this range. So 4 or 5 ticks. If that buying stops and you then start seeing selling coming in, the market gets pushed back. This isn't what I want to see. I've used that buying as my reason to get in. If that's gone, I'm out of the trade. So it could be it's an element of order flow sometimes that says, well, this isn't happening anymore. I don't want to be in this trade. Now, after that, once the market starts to move higher, what you got was this skip up. You got a skip here at around about 32, and you got a skip here at around about 35. And this was 32. So when I'm looking to buy at 38 and the bottom of that little range, what I'm now thinking is, right, my stop really is below 35. If I really want to give myself a bigger chance, my stop's down here at, say, 30. So at worst, I'm on an 8-tick risk here. Now, remember, the target on this is to break the high ultimately. Yes, you're scalping up towards 46 at the same time. So it's a roughly 1-to-1 risk reward, but you're playing in the direction of the move. So yes, some would look at it and go, well, that's not great risk reward. But you're giving yourself a 1-to-1 risk reward with a high chance of payout. You know there's now news in this one. And also, the market keeps on trading up and down this range. So let's say you manage to take this 3 times. Even if you got stopped out once, it's now a 3-to-1 risk reward on the trade. So I'm always sort of dynamically adjusting stops. But once you get these little surges up, I'm generally sort of readjusting and saying, well, if the surge took us up here, that's where buyers are in control. As long as buyers stay in control by not falling into that area, I should be safe on this trade and I can stay in that. So yeah, I'm always kind of dynamically moving stops up. There is an element of intuition, but it is predominantly based on where those little surges come from, so that I'm not sitting there buying up here with a stop all the way down here, because that, well, is suicide. Because what ends up happening is you take a huge risk and it never moves far enough. So whilst, yes, you wouldn't lose if you did that, the risk on the one that does turn back, i.e. the one on the 3rd and the 17th and the 26th, you would have got burnt really badly. So I'm always sort of dynamically moving my stop up and using those little surges, those little changes as a way of trying to sort of realign my stops. So that's how I do it. So it's not a set number of ticks, but you're constantly being able to update it based on what you've just seen.
Okay, cool. Right. So the next question, an interesting one. Is this a more advanced strategy?
It's perhaps more advanced in the sense that, you know, it's certainly not the first thing that you're going to jump to. And this isn't to put anybody off. And the reason that most people probably won't jump to this first is because of the speed of everything that's going on. If I was to say to somebody, the best thing you can do on a sim, though, if you want to learn order flow, or if you've got a replay functionality, is go and trade stuff like this. Really fast moves. Go and pick data points and trade those. Because whilst, yes, it's certainly feels like it has a higher level of risk in it, the movement is much clearer. And so if you can get over the fact that, yes, it's going to whip around and it can jump 10 ticks on side and back to you and jump and jump and jump, the points where it stops are far easier to recognize, because you're getting far more activity, far more volume. Look at the chart. You can see what I mean in terms of volume here. huge amount more volume. So if you're getting that, what that tells you is the market's going to move quicker, yes, but it's far, far cleaner at reaction. So yes, perhaps it is slightly more advanced in terms of something that you don't immediately think to do. But in terms of being able to learn, these are the best opportunities, because these are the ones where you get multiple opportunities to trade in very, very quick succession. And the quicker that you can sort of learn how to do some of this, you don't have to be brilliant. The advantage of volatility is you can make mistakes, because this is going to give you 10 chances. When there's no volatility, you get one chance. If you get that wrong, well, what else are you going to do? There's not much more to do. So I wouldn't necessarily say it's advanced. It's scalping faster than normal, but essentially the concept's the same as normal scalping. Normal scalping is recognizing a range and playing it from the bottom upwards, or recognizing a little surge higher and buying for the move to the next level. This is the same. You're just doing it faster. So the one thing you have to get used to is the speed of decision making dynamically. But outside of that, it is ultimately the same. And you're just transferring that skill set and doing it quicker.
Yeah, that's cool. A couple of people have been asked if you could expand a little bit on how you identify levels of support as you're going through the trade.
As I'm in the trade, I kind of semi-answered this in the sense that one of the main things that I'm watching for, and I'm not sure. Give me just a moment. I'll see if I can flick this video back up for you. Let's have a quick look. Right. Just try to remember where it skips up. Okay, so one of the things that I'm watching for in terms of areas of support is where the market jumps. So when it does these little jumps, I sort of suggested this earlier. So I very quickly just press play on this. I think we're roughly around about the right area. You'll notice here, as it starts to tick up, it will have this quick little jump. There you go. A little bit of speed towards the upside. And then after you see the speed, all I'm doing is I'm watching very, very quick. I'm like, where does it pull back to? Where does it pull back to? So on that one, little bit of speed up towards sort of 39, drops, and it sticks at 36. It doesn't mean I'm buying 36 straight away, because I don't know where it sticks. But as it rolls back, I'm now thinking, right, stuck at 36. That's now my area of support. It did it again there, rolled back and it stuck at 38, and then it jumps. So now when it rolls back, I'm watching. So I'm always watching, right, where's the low of the flicks back? This one, again, down towards 37, 36 again. So this is my area of support. That's the bit that I'm interested in. So that's how I'm recognizing the support from an order flow perspective, particularly when the move down is fast. It drops down, it stops. And where it stops is your area of support, because what's happened there is that selling pressure that drops it down runs out. Sellers run out at whatever that point is. Now, that could just be purely because sellers run out. But now you've recognized it and other people recognize it. So from a buyer's perspective, if someone needs to buy, now they've got to try and buy there, because the market's not going any lower. It didn't on the pullback. So you assume that's as low as it's going to go. So you try and buy there on the pullback. So that's how I'm recognizing, or I'm establishing those little surges and then lows of quick pullbacks. So you kind of, in your head as you're watching, you're sort of totting up levels. You're right, 32, 36, 38. These are the levels that matter to you. I'm not getting myself worried about every single tick along the way. It's just looking at those levels as it flicks back. So that's how I'm establishing levels. It's a dynamic process. What I'm certainly not doing is sitting there looking at a chart. I'm not looking at a 1 minute chart or anything like that. I am very much just watching for those flicks. So that's it. That's how I find them.
Okay. Right. Somebody, have you got the chart from October the 30th? Somebody's asking what was causing the long candle wicks on the October the 30th before the move.
This one.
Any thoughts on that? Yeah.
Well, actually, that was within the move. So that big wick that you see here, this first wick by the orange arrow, that was the one we literally just saw, where it jumped up and then it whips back down. I'm not sure how well you can see the prices on here, but there, I'm very sure I can't draw a great straight line. No, not bad. That's 37. So those big wicks were those flicks back. So as it flicked back, that was the 37. And so that was then that range that you saw it trade up and down and up and down in. That's your sort of 37 up towards, whoops, terribly straight line, up towards 46, which comes in there. And then you see after that, we actually then used 46 roughly as support. Okay, it holds just above 46. So that was the wicks. It was basically that after that first move, what you've got to be thinking about, remember what I talked about before, think about what your opponents are thinking. Everyone's seen the previous ones that have gone up and straight the way back. So people are now going to be quite nervous that this is going to do the exact same thing, that this is going to go up and straight back. So they all want out, which is why you get these quick flicks down. As it becomes clear that there is buying here this time and the market's not going to roll back down, and as it becomes clear what the news is, and people will find this out at different speeds, as that becomes clear, now you actually start getting buyers who are countering that selling. They're trying to get long for the next leg. So you do have a situation where it is clear what's going on, and that's what's creating those wicks. People sell to take their profit, but the fact that it doesn't roll all the way back is what then keeps the market up. And you also see that being from algos as well. Mean reversion algos will see that fast move up and go, this isn't normal, play it back down, and it will rip back down. So simplistic view of algos, but that's how I kind of mentally think about, some of the things that they do, that they'll see a move that quick on that much volume and go, this isn't typical, we need to sell. And that also is what creates the whips back. So never be scared of those whips back. Look at the whips back and try and work out where your support is.
Okay, somebody's asking if you use tick charts and what do you think about them, and just charts in general, I guess.
I don't use a tick chart. Personally, I think if you're watching a ladder, you see every tick. Well, the last thing I want is something to the side of me going tick, 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 all over the place, because you're seeing it. You're watching it live. Any kind of chart, and charts in general, charts are wonderful. Charts are a map. That's the way I see a chart. It's a map that tells you where we've been, and so it pinpoints areas where you could essentially turn. Think of it like a roadmap. But that's created historically, right? It's created from what's just happened. After that, as you get to those points, as you get to those turning points in the road on a chart, well, you've now got to make a real-time decision. The real-time decision is like driving your car down the road. The map says you can turn right. When you get to that right turn, you look and you make a real-life decision about whether you will. If you look to the right and the road is completely cut off by a flood, probably like a lot of roads near me at the moment, you don't turn right. You don't blindly follow the map. So the big advantage of order flow, and this is why it's so, so vital that you're looking at everything on a ladder, is that's the real-time ability to go, okay, this still looks like a good idea. The map said turn right, and I should. It's a clear road. But if you get to that point and you turn right and you look right and you think, no, I'm not going to go down there, that's order flow saying to you, no, this doesn't look right anymore. This doesn't look good. So I love charts. Charts give you those reference points that I talked about in the first question. But a tick chart is just updating on literally what you just saw. You just saw something and now it tells you you just saw that. And you think, well, of course I did. I remember seeing that. I want to deal with the stuff that I'm not going to remember precisely what happened. So, personally, I think a minute chart's as short as you need to go.
Okay, that's great. Have you got any advice for people who are only trading a couple of contracts?
Well, in terms of scalping, I don't think there's necessarily a problem with that. You are going to have to be a little bit more, a little bit less dynamic in terms of your ability to sort of increase, decrease. Because obviously, if you've only got two, let's say on a move like this, you get two in, get one out, and then get one back in, and get one out and get one back in. But what I'd always try and do, particularly if you're trying to play these larger moves, is try and maintain at least mentally your core position, i.e. where did you buy for the bigger move? So let's take that chart again that we've got up there. If you're buying this for the big move up to here or wherever you think this might be going, and you buy two down here, I would always keep in my head that one of these contracts is going up here. So whatever you do, you can get out, but you always need to get that back. So even if you sell 2, you've got to at least buy 1 back, which is why recognizing these pullback areas is so important. You can recognize those, then you buy the 1 back. You can sell, you buy it back. But by keeping 1 in all the time, it means that you don't miss the move. Because if you go all in, all out, and then all in, all out, the danger that you then have is that the time that it goes, you're all out, and now you're trying to work out how to get in this mess. And that's horrible. So, you know, if you're only trading smaller size, I don't think it should inhibit your ability to do this type of thing. But try and always keep in mind where your core position is, or what exactly you're trying to do. If you're not trying to carry a core position, then yeah, absolutely. Get out, get back in, get out, get back in, get out, get back in, and do it like that. But if you're trying to carry a core position, remember what the core position is, and sort of mentally say to yourself, right, 1 lot is going from here to here. And so you must have 1 contract on at all times. Take it off, put something back on, take 1 off, put 1 back on. Constantly sort of keep that trade going in that way. So I don't think trading smaller size inhibits you necessarily. Obviously, once you started to build up on a couple of trades like this, start to increase the size. Start to take that 2 to a 3, and then you can scalp 1 and carry 2, or you can scalp 2 and just carry the 1 still, dependent upon what your preference is. You know, if you're more of a swing trader, hold 2, scalp 1. If you're more of a scalper, hold 1, scalp 2. So that way you learn both skills. So yeah, that would be how I'd look to try and do it if I had to. You know, that's how I started. I started with 1 lot in the DAX and doing it like that. And then you sort of get to 2, and you're like, right, I can start to hold on to 1 now. And you start to then learn more skills. So scalping is often the gateway into trading, because it gives you the ability to learn some skills. And then as you build your size, then you can start to learn the more sort of bigger swing type trades, which I would say come secondary. So that would be sort of the way that I'd look at it if I was trading 1s and 2s.
Okay. There's one of the questions, Saj. I'm going to skip your question because we haven't got the chart up, so I can't really see what part you're talking about. Can you see these levels easier on the footprint than the DOM, or trade? Basically,
I don't necessarily think you can. Again, a footprint like a chart is ultimately telling you what you've just seen. What I think a footprint is very good for is confirming what you thought. So let's say on that one where it whips back down and it said, oh, it seems to stick at 38. You look at a footprint, particularly if you've got a range or rotation-based footprint, and you can see that it does seem to stick at 38. And you can see you would expect to see absorption from buyers. So as the market comes down, you see selling. So you see this passive buying. The footprint's very useful for that. So I think it's a great additional tool, but I don't think it would be a substitute for a price ladder, because the footprint doesn't show you the passive orders. You'd never see that 200 appear or that 800 appear just on a footprint. You'd see it after it's done something, at which point it's done what it's doing. So now it doesn't have any impact. So footprint's very useful for confirming what you thought you saw, but I don't think it's a substitute for a price ladder in any way.
Okay, when the market is rotating, as in your example, do you ever take a short position at the high of the range? And if so, how do you manage risk?
That's why I don't take a short position at the high of the range, because it's very hard to manage risk, because obviously you don't know where the high of the range is, right? So when I said the market's trading in 38 to 46, well, realistically, if you go short 46, your stop has to be above the high. And what the danger of that is if this is a continuation move, when it goes through the high, it is probably going to go through fast. We saw that it surged through the high here. So when it does that, you could end up getting slipped on your stop. So what I don't really want to do to mitigate that risk is to try and play both sides of the trade. Yes, that looks wonderful. If you buy it and sell it and you sort of, you're long, short, long, short, long, short. If you capture all of it, wonderful. But the problem is when you get caught on that, one, it's harder to establish your risk, because over the high is quite a hard thing to say, well, okay, I'll put my stop above the high. If this jumps through the high, you get slipped on your stop. If it only just ticks through the high, then you may well get stopped out and the market still come back down. So, for me, one of the ways to mitigate risk is to not take trades that give me an unnecessary, undefined risk. And so that's quite simply, that's the way that I would do it. I wouldn't go short. I'd look at this, go, well, this is clearly a market that wants to go up. So in that case, well, I want to join that. I'm going to buy and play upwards because the probabilities lie more on the side of this break in the high than it going back down. And if it goes back down, I've got well-defined risk, which we discussed a minute ago. So I've got well-defined tight risk on a move down. On a move up, I've got very poorly defined risk, and at minimum, a bigger risk. And I'm going against the direction of the market. So personally, I wouldn't do it. I'm not sure why I need to be both sides of a move. I prefer to play the probabilities in my favor and be on the long side of this because that's the direction of the market.
Okay. It's an interesting one. When you're looking at products that move fast, or you can't, I'm not going to ask that question as well, because do you recommend shrinking the ladder? Richard probably doesn't know about that feature in Jigsaw, so we probably no point asking that question.
Perhaps not. No, it's probably one for you to answer, Pete.
Yeah. Somebody's asking, interesting. Somebody's asking advice. How can you get a job at a place like Axia? How can you go asking, how do I get a trader job?
Okay. There's a couple of different routes. Contact us if you've got past experience, then drop us an email, info@axiafutures.com. If you've got past experience, then we would be open to considering somebody coming and joining the team as a trader, bringing their trading account across. If not, then what we do for anybody who's come and joined some of our programs, we have a funding trial available, so people can come join the funding trial. We're there also to be to support people through the funding trials. Unlike a lot of firms, our business is not trying to get people to do funding trials and retake the funding trials. Ultimately, we want traders to succeed, so we're going to be there to support people. This is why we suggest doing a funding trial with us. You're better off to do it once you've completed the 1 week or the 6 week course. This way, you give yourself the footing, the greatest chance of passing. Don't view a funding trial as something to have a punt at. View it as something that this is a means to an end. Ultimately, this is what's going to get you trading. So there's easy routes in. Contact us, info@axiafutures.com, and that way you'll be able to potentially bring a trading account across if that's the situation that you're in, or alternatively, you can join us 1 week, 6 week course, and then come and join the funding trial on the back of that.
Okay. Somebody's saying, can you say something about time sliced orders and news trading? I don't get that question.
A time sliced order is an order where somebody will, let's say you've got 500 contracts to sell, and it's a automatic order, I believe, whereby somebody will sell, say, 50 contracts every 3 seconds, 2 seconds, 10 seconds, 30 seconds, whatever it is. The advantage of that over news would be that they're constantly able to sell and get probably higher and higher fills within a move. So it'd be a great way to exit a large position that you've got over a piece of news. But in terms of their impact and your ability to spot that, I think is very limited. I think it's very, very hard to spot something like that, because you'd essentially be looking for a consistent size order of which you don't know what that size might be, and then also able to recognize the time increments within that as well. It'd be tremendously difficult to spot, and ultimately won't make a great deal of difference to the way the market actually moves. So that I wouldn't worry about it. Sometimes I think there's things out there that you're not going to be able to recognize that are not worth worrying about. Algo's prime example of that.
Okay, are you still good for some more questions?
Yeah, should do a couple more questions.
Yeah.
Make the last two. Make them good ones.
Do you take this trade around no news releases always, or is it something you find occasionally in the market you trade? I think you probably, let's not use that one because it is, I think we've covered that in the topic.
Yeah, the early part of the trade, I would say, yeah, that's something that you could always be looking for. Definitely, that early sort of change in the way the market ticks up. Where it leads to may well depend on whether there's news or not. So you may not get the ferocity of movement if you don't have something to support it. But yeah, it's still something I'd definitely be looking for.
Okay, and then last one. Ladder traders sometimes say ignore the resting orders. Should you assume they are misleading orders or worth observing?
I would massively struggle to trade on a ladder if I didn't have the resting orders. And if you don't have the resting orders, if you're ignoring the resting orders, I would question why you're looking at a ladder anyway, because then all you'd be seeing is the time and sales or the last traded quantity. Essentially, you'd be seeing a footprint. So for me, the resting orders are vital. The resting orders give you a sense of people's intent. Yes, some of them are fake. Of course they are. But a lot of them are not necessarily fake. They may well be somebody who wants to buy, but then in light of the way the market moves, they may decide, actually, I don't want to buy this anymore. Let's say you've got a large bid and then the market shoots back down. You might decide, I don't want that. So I think they're vital. Yeah, we saw in this example that as the market started to tick up, you then got a 200 lot joins the bid and it moves up and it becomes 800. Now, I'm not looking at that thinking that's fake. I'm looking at that thinking the market's just moved higher. Somebody now needs to buy and they've pushed their order up. They're trying to get filled. This has an influence and this will then get other people to start to buy. It also provides a perfect place for you to buy ahead of because you've got a well-defined stop. If it goes through it, you get out. So, and we saw that on the break of the highs on this one. So go back on this and go and have a look. But yeah, the passive orders, the resting orders in the book, absolutely vital. It's the interaction of all parties that matters. It's not just the people hitting market. It's the people waiting and understanding what they're doing. When it comes down to somebody spoofing a market, flipping, actually putting orders that they don't want, yes, they're fake. You can spot that. That's what I'll be covering in the next workshop that we're doing on the day before Thanksgiving. So come and join that. I'll explain exactly how to recognize fake orders and what you can do about it and how to not get caught by them. But if you can't see them, you could be getting caught by them and not even knowing it. So yeah, I think they're vital.
Yeah, thank you, Richard.
Not a problem.
Just a quick question. Can you guys see the link in the, sorry for the guys in the room.
I was going to say, I certainly can.
Can you guys see the link for the next session? Just give me a Y, somebody, if you can, in the chat or the Q&A.
Yeah, if they can click on it inside of the chat area.
Got it. Well, with that, because we've answered all the questions, I'm really apologize if you didn't get your question answered. Richard, Craig, thank you so much. That was
not
very
a problem.
enlightening.
Pleasure doing it.
And with that, we shall bid you goodbye, and there will be a recording of this session, and I'll send out an email about that in the next few days.
Wonderful. Right, thanks for having us, Pete. It's been a pleasure.
Thanks all,
thank you,
and see you again soon.
Take care, everyone.
Bye.
Cheers, guys.